Right now, the stock market feels like it's completely ground to a halt. While the herd is frantically chasing daily headlines and short term surface splashes, an unprecedented amount of economic pressure is quietly building directly beneath the surface. I call it a wave in waiting. High interest rates have forced leveraged closed end funds to pay massive premiums to finance their portfolios, temporarily dragging down the net asset value of legendary bond managers like Jeffrey Gundlach and PIMCO. But price movement alone is not an investment thesis. So, hello, my name is Daniel Young, and this is Adaptive Perspective. Every week, we separate currents from noise and opportunity from fear using an income focused strategy in closed end funds. This isn't polished, it isn't scripted, and it's definitely not hard thinking. We don't chase headlines, we navigate markets. Now, let me be clear, I'm not a financial advisor or fiduciary. I'm an income hunter, a strategist who filters the noise, follows the data, and targets durable cash flow, even when that means taking a different course. And in this Sunday briefing, we're breaking down the hidden mechanics of fund leverage, mapping out the impending interest rate slingshot, and revealing how to read the deep capital flows before the massive wave of liquidity finally breaks. Let's look at the data. Have you ever watched the old movie, The Day the Earth Stood Still? Even if you haven't, the premise is pretty obvious. Everything stops. And that's probably the easiest correlation I can make to this market. Except it hasn't been a day, and the market hasn't actually stopped. The currents are still flowing, our top four financial currents haven't changed, and the economy continues moving. But something has been holding the market back, and actually three somethings. One, the general investor's timidity. Two, large investors chasing the surface waves. And three, the Federal Reserve maintaining higher rates while waiting for more evidence that inflation is under control. Think about a wave pool. You can manipulate the timing of the waves and lengthen the trough between them by delaying the next wave. But you can't eliminate the water or the pull of it. Eventually, that pressure has to go somewhere. And that's where I think we are, in the delay. And just like a kid in a wave pool, we're all ready for the wave and waiting. And when rates finally move lower, I don't necessarily expect the first wave to be the biggest. But after waiting this long, it may feel that way. And that's exactly what made last week's conversation about 1 year NAV data so important. 1 year NAV or net asset value is useful, but it isn't absolute. If you look at this week's data alongside last week's, which I put them on the same spreadsheet, you could easily conclude that some of the biggest names in bond investing suddenly forgot how to manage bonds. Jeffrey Gundlach, PIMCO, Zava even, these aren't amateurs. They are bond specialists who have spent decades navigating these markets. So when several of their funds show weakening 1 year NAV performance at the same time, I don't immediately conclude that the managers suddenly lost their ability to trade bonds. Ask a different question. What changed underneath them? And one answer is the cost of leverage. When short-term rates remain elevated, leveraged closed-end funds pay more to finance their portfolios. That pressure can weigh on net asset value, even while the underlying long-term thesis remains intact. And if those funds are simultaneously working to maintain their monthly distributions, the pressure becomes even more visible. That doesn't mean the funds are broken. It means we're seeing the cost of the current environment. And this is exactly why the 1 year net asset value NAV or net asset value tool needs context. The number tells us what happened, but it doesn't always tell us why it happened. So this brings me back to the deeper current idea. We talk constantly about ignoring surface noise, but sometimes the pressure created beneath the surface eventually creates new noise of its own. That's what happens when you hold a system in place. Pressure doesn't just disappear, It moves like the cabin pressure in your car. The air has to go somewhere. As the as the Federal Reserve holds rates higher for longer, pressure is growing. While the Fed waits for additional data and tries to control the pace of the next movement, I'm wondering just how much, just it was fun writing this, just how many more data points they want because the economy hasn't stopped while the Fed sits and waits. Businesses continue building, technology continues advancing, energy production continues expanding, capital continues moving. And eventually, the pressure created by all of those things has to express itself somewhere. That's the wave I'm watching. Not the headline, but the pressure behind it. Meanwhile, the average investor is watching the surface. Oil goes up and oil goes down. A geopolitical conflict gets worse, then better, then worse again. Inflation gets mentioned a lot. AI dominates the headlines, and every new headline creates another reaction. But this is where context matters. The United States is producing enormous amounts of energy, and our domestic economy isn't dependent upon the same global oil dynamics as countries that rely heavily on imported energy or imported oil. Technology is also increasingly deflationary, and we're still incredibly early in the adoption curve. We know companies are using AI, we know employees are using AI, but widespread enterprise level integration is still developing. When companies begin integrating AI throughout their operations, not just experimenting with it, the productivity gains could become much larger than what we're seeing today already. And that's another current beneath the surface. While the herd chases the obvious technology story, many investors are looking at bonds and seeing nothing but red numbers. That's understandable. It's also exactly why we need to think differently. Yeah, that's the text noise in the background is exactly that, text noise. It's the day is reaching a close, and at the same time, our family business is not done. All right, so I don't need the Federal Reserve to be the villain for me to recognize when its decisions are affecting the water. Higher rates have remained in place longer than I believe the economy ultimately needs. I believe their fear of losing control contributed to that. But that's not my fight. I don't fear the Fed, Jerome Powell, or Kevin Warsh. I don't need to convince the Fed to do anything, and I certainly can't control what they do. My responsibility is much simpler. Read the water, recognize the changes, and adjust the course as needed. That's what we're trying to learn here, because the captain who spends all day yelling at the weather isn't navigating the ship, he's just yelling at the weather. Quite honestly, I don't know about you, but you can yell at the weather all you want and nothing's going to happen. So I still believe that rates eventually move lower. And that's not just my opinion. The economic data continues to build toward that conclusion. Warsh was brought in with a very different philosophy about monetary policy, and eventually the data will give the Fed the room it needs to move. When that happens, the cost of financing falls. Businesses can finance expansion more cheaply, infrastructure gets built, manufacturing expands, AI investment accelerates, and the bond funds that have been fighting against elevated short term borrowing costs suddenly have a much different environment underneath them. That's the slingshot. The market doesn't need the miracle, it needs the pressure to be released. So let's move into this week's closed end fund snapshot. Our strongest financial currents remain bonds and select bond proxies, real estate, end to end energy, and the technology family tree. And this week, I want you to look at the snapshot a little differently. Don't ask, is the fund's NAV up or down, which we're going to go over that. Ask why. Ask why. Ask what's happening beneath the number. Is the current changing? Is the fund experiencing temporary pressure? Is leverage more expensive? Is the thesis breaking? Thesis meaning we're in stagnant rates headed to lower rates. Or are we simply watching the cost of a wave that hasn't arrived yet? In other words, don't just take the spreadsheet data or the fund data at surface level. Think about it, see how it fits into the schemes. I'm not asking you to predict the future. I just want you to see and to think deeper than the average person. So let me change screens and then share my list. So this is last week's list. We'll get to that. For now, let's look at the top list, which is this week's list. It's still relatively the same group of funds, right? We're looking at targets based on individual fund history, what significant discount compared to each fund's individual data. I like monthly payers, also monthly players, instead of quarterly. And then specifically, we want 9% payers or better, unless there's a good reason to consider it. And RFI and PDT fit that threshold. So these 7 funds make the pre-final list. And what I had been doing is marking funds based on the 1 year NAV data. Like BRW is down, HTLB is kind of flat, PTY, PDO, DLY, and even DSL for that matter, which is not on the list for the week, are down year over year. PDT and RFI are up year over year. So it's not like these 4 funds suddenly lost, or the fund managers lost the ability to manage their funds. It's just a representation of the strain they're feeling in the current market with stagnant rates. HGLB, we've discussed. And quite honestly, of what I learned today about HGLB, or maybe what I've forgotten about HGLB. So one, they're still invested in Fermi, which I love the concept of Fermi, data centers, tech center, all of that stuff. I like that idea, but they don't have a client yet, and they're still looking, or a tenant yet, and they're looking for one. Eh, But looking for one is not having one. So 5% of the portfolio almost is weighed down by Fermi not having a tenant. The other part of their portfolio, which either I knew and forgot or I can't explain, but almost 7% of their portfolio is invested in HFRO. So I already have HFRO in the portfolio. It's kind of odd to hold HGLB2 when it also has 7% of HFRO in the portfolio. And I don't know what to do with that data yet because BRW has at times owned funds that I own. So I don't like double investing. Like I don't want to invest in one just to buy another who also holds a significant amount of that in their portfolio. But I like some of what HGLB has. I loved it when it had a more controlled mandate, but it's become an all-weather system, much like BRW. But they are skewed a little bit differently, or maybe built a little bit differently. So here's the list. And so if we look at BRW, which I think 50% of their portfolio is invested in bonds and loans. Then you have PIMCO funds, double line. You look at primary bond accounts. HGLB might have 12% bonds, and then it has just a lot of other stuff. PDT has the preferred account plus energy with the rising dividend, and RFI is the unleveraged version. So you have RFI and RQI, pretty much the same exact portfolio. It's just RFI is unleveraged and it is steady as you go on payments. And in looking at last week, it's very much the same. I mean, these are filtered based on discount. So the ones we're missing, IGR I left off. It's still a dollar cost average buy. Um, this one's missing. DSL is missing. Yeah, otherwise it's the same list. So of the list, could I actually pick something that I would invest in tomorrow? And the answer is yes. Of the funds listed, PTY is the cheapest it's been in 10 years. Um, it's in the grand scheme of things, I mean, compared to our initial buy-in price, it's not that much different. It's like splitting hairs in the grand scheme of things. However, price-wise, it's the cheapest it's been in a decade. And on the cash brokerage side of things, that 1200 amount, which is what I currently have, it makes the most sense on that side of things. Pick up a 100 pack, call it a day. On the Roth end of things, I could maybe pick up, yeah, of all of these funds, I could at least pick up 50 shares in these funds, in all of them, or like one of them, but all of them I could pick up 50 shares in. But and mm, I've talked about this. Initially, I could buy 10 shares, then I like the idea of 50 shares or 100 shares because I like the math better. But if I could buy just 100 shares, I like that over 50 shares. But I could pick up 50 shares of PTY. That's true. But I would tilt more toward picking up 100 shares of one of these two. I could make a case for HGLB. I, on the surface, I dislike the portfolio when it can, but I do like how they're laid out. Utilities and energy, real estate, data centers, technology. But I also I, I hesitate because of the Fermi investment, but also that they're invested in other things. 34% of the portfolio still tilts toward midwave wireless. And it's an unknown investment. It's an investment with a lot of promise, but it's still a big unknown. Also, the HFRO component, like I'm already paying for it. Well, not paying actively. I already own HFRO. It does sound a little duplicitous or redundant to buy it secondary in another portfolio. So I don't know. I think what makes more sense is buying BRW because though both funds are all weather, BRW tilts more toward bonds and bonds outright, and it is the better all weather portfolio. Um, Weinstein or Boaz Weinstein, who's managing and heading up Saba, is looking for discounted closed-end funds and just discounted opportunities, discounted private credit that he can really convert into something significant. So the fund itself is on discount and it's below our buy-in price. But of what he's doing already, he's taking the same approach. He's got a contrarian mindset, looking into what he can pick up at a great deal and then turn it into something profitable. And I like that mindset. I like BRW's activism on the shareholder side, improving companies so they pay shareholders better, but also improving companies so they perform better. So I think I tilt more toward BRW than HGLB. HGLB, I like it. And with this exit strategy I'm developing, it's still, uh, which I think I showed that last week. I honestly can't remember. But I've added an exit strategy for every fund in the Roth. I still need to work on the uh, the cash brokerage. Last week got busy, but I still need to work on that. So it still fits inside this exit strategy of not needing an exit strategy or not needing to exit per se. But I don't know if I'm going to hold it, knowing or relearning that HGLB holds a significant 7% is significant. 6.8%, almost 7% is a significant holding, but not 34% like midwave wireless. Um, and it makes me question keeping it in my portfolio. but I got to sleep on it to see if probably sleep on it, pray about it, think about it, uh, and see what the best move is there. But for this decision, uh, and if I would buy tomorrow, I would buy tomorrow. It's been 4 weeks since we bought the last time. Um, in the easiest buys with that fit what I have, which I'm not playing with imaginary money, and I'm not playing with the concept of we'll just randomly take a number like 5 grand or 10 grand and play around with it and see what we would buy. This is the money I have, so and it's all dividend money. So I would take the cash brokerage amount and buy 100 pack of PTY, and I would take the Roth amount and buy 100 pack of BRW and call it a day. But outside of that, those are still these are still the top funds for the week. You have real estate unleveraged, hybrids plus a sleeper energy fund. Um, it's U.S. focused bond with less leverage overall compared to DSL and these other PIMCO funds. And then we have PDO, which is a term fund, PTY, which is just a well-performing fund, HGLB, and then BRW we've discussed. So take that how you will. And I'll leave you with this. Howard Marks, who's the co-founder and co-chairman of Oak Tree Capital Management, talks about the difficulty of contrarian investing. And the best opportunities often require you to act when everyone else is uncomfortable. And that's not easy. And I'm not suggesting that every failing fund or falling fund or discounted fund is a buying opportunity. It's exactly the kind of simplistic thinking we avoid. What I am saying is that price movement alone isn't a thesis. A falling NAV or net asset value is information, and a rising NAV is information. But neither one tells you the whole story. You have to dive deeper and dig. You have to ask what caused the movement and understand the current but underneath the surface. And then you have to decide what that information means for your position. That's the entire point of adaptive perspective. I'm not here to tell you what to think. I'm here trying to teach you how to think. And I don't know exactly when the wave is coming, and neither do you, neither does the Fed for that matter. But I can see the water around me, and I can see the currents and see the pressure building. And when the water changes, which it will, I'll adjust the ship because that's what a captain does. You don't control the ocean, you learn to read it. You learn to recognize when the current changes, and then you move. So that's all I got for the week. Last week got busy for me. This week, I already have a to do list. I know you have one as well. So, whatever you have to get done this week, I wish you success. I wish you a productive week. And I encourage you to start going through your portfolio, and if you haven't already, and looking at the currents and how they apply to what you have. And then also to devise an exit strategy for the funds you already own. And it, it it's not glamorous work, but it's worthwhile and worthy work because it helps you know when to sell funds. So figure out why you're buying funds. Most people can do that. Figure out why and when you should sell funds. That's the harder part. And then create that exit strategy so when something shifts and that event triggers, it's an automatic sell and not an emotional thing or anything else. It's just this changed, that happened, cause and effect, right? And again, I'm not telling you what to think. I just want to help you learn to think. So have a great week, everybody. I wish you a productive week, and I will see y'all next Sunday. Bye bye.